If you're ready to take your finances to the next level, you're in the right place. It's time to take control of your future, starting now, and we're doing it live. Hi, we're the Stidhams, and our goal is to help you get self-directed. It's the tax-free income that will shape your legacy. It's wealth, time, and the freedom you deserve. What you're about to learn will enable you to make confident and strategic moves. It means gaining complete control to invest in what you want when you want. We've helped thousands of people just like you. And if they can do it, you can too. So we hope you're ready, because it's about time that your money started working for you. And we're so excited that you chose us to show you how.
Starting right now.
Welcome to the next stop on your journey from paycheck to pension. If you're ready to take your finances to the next level, you're in the right place. It's time to take control. And that was not on purpose.
Starting now. It's all right.
Yeah,
Everybody has to play twice.
Okay. Yeah, maybe
Sounds so nice. Had to play it twice.
That's right. Yeah, welcome everyone. Thank you so much for joining us. We have a new intro. I added some spice, some sauce. What y'all think? Hey, Robert. Yeah, we got our folks over on LinkedIn. We've got our folks coming in on YouTube. So glad to see you all. Okay, so velocity banking has been a hot topic for us. The feedback that we're getting is, Donnell, we love how you teach it, and we like that it's we've kind of simplified it, and really that's not our biggest focus, right? Velocity banking.
Really
and
not.
I think now is a good time to just quickly remind or let people know, what is it about us that makes it different than other velocity banking videos that they might see out there, and why is it so important to us that we include this as one of our strategies that we teach?
Yeah, and because I think it boils down to it's a strategy. It's one of the many strategies we use to just reduce debt and put ourselves in a much better, I'll call it positive cash flow position to be able to achieve the true goal. And the true goal is more about legacy and generational wealth and, having more control over time, the WTF moment. It's really more about that. And velocity banking just happens to be one of those levers we've pulled, currently pulling or have pulled to be able to put ourselves in that position. And as it relates to me specifically, I'm a retirement planner. I'm a licensed life insurance provider. I have tools and strategies available to help you achieve your goal. So I am not just, hey, these are the numbers that you need to put in place to be able to pay off that debt or whatever the case may be. So I think it's a little bit bigger than that. I think that's what the bulk of what today is about, is kind of better understanding how I serve. But in addition to that, what makes us different compared to the others who also do velocity banking.
Yeah. And we approach velocity banking differently. So you might learn a new approach to how to get started here. So whether you are already in your velocity banking journey or just getting started, I think you have something that you will take away, aha moment today, hopefully. And we'd love to hear your feedback. We always love to hear your feedback. So please always put those in the comments. We'd love to hear the impacts that we're having on people, on families, on legacies, on generations to come. That's super meaningful for us. So we're grateful you're all here. Hey, we got some good ones watching today. I love it. Of course, we don't know that you're watching unless you comment.
Right.
It's a secret. It's a secret until you comment. That's cat's out the bag once you put it in the comments. So, but anyway, let us know who to say, who to thank for tuning in too. That's also important. Okay, so velocity banking, how do we get started? What are the first steps? I think the majority of people are probably going, I don't even know how the heck to start this thing. There's a lot of information. It's like a fire hose. And what are the first steps? What do I do? And I think that's what we've kind of mapped out today. And I'm excited for you to share it.
Yep. Kind of just to set the stage a little bit. There's a lot of videos, velocity banking videos out there around how do you get started. And the ones that I've used, even if you go back 2 years when we did our first, or I think it was two, maybe even three,
Three.
three
Yeah.
years when we did our first velocity banking video, I think the steps of how you go about it, where do you get started, are the same as what everyone else is saying. But what I like to do is just kind of walk through what everyone is saying and then kind of share with everyone how I approach it, especially when I'm working with someone or someone has asked if I could give them some feedback on how to approach velocity banking. Again, I'm not here to coach velocity banking. I can't be hired to help you do velocity banking, but I can absolutely work with you to identify where some opportunities are, share with you what my opinions are, and we can kind of go from there.
Yeah, and I am so glad that you said that because there was somebody else who was like, "Hey, can you?" In a sense, they were kind of asking like, "Can we hire you to help us with velocity banking?" And the whole point here, folks, friends, fam, is that our goal is to teach you how to do it because isn't it an amazing feeling when you walk away like, "I got this." I know I can do this and I can make these decisions and I don't have to be dependent on anyone else to just like ball out on this. It's honestly, that's the gift that we're giving to you is that we are breaking it down in simplest forms so that you can learn it. And it's really like a each one teach one, right? Not only do we want you to learn it, we want you to then go tell your kids about it, tell your parents about it, tell your friends about it, so that everyone can start their wealth building journey. That's the most
Right.
important part.
And this is about becoming self directed.
Yes.
Okay, so what does being self directed mean? Self directed is about control. And the question that I love to ask is who controls the things that you want to do today? So if we're talking about that WTF moment, the objective is to be able to build wealth. Well, what are you doing right now to be able to build that wealth, and how and who has the majority of the control as to how that wealth is being built? Meaning, are the vehicles you're using subject to market risk? Are the vehicles you're using riddled with fees? Like, who really has control as to how wealth is being built? And then time. Who's in control of your time? When you want to take that day off, or when you want to, when you decide that you want to spend time somewhere else other than at your 9 to 5, who has control over when you decide, when you're able to take that time? Who
Right.
controls your time? And then freedom. Freedom is relative. Freedom is not a dollar amount. Freedom is absolutely, hey, I am in a position to be able to do what I want to do, with whom I want to do it, whenever I want to do, whenever I want it done. So it is
Right.
totally relative. It has nothing to do with the number. It has nothing to do with being financially free.
That's
And,
right.
and that's the goal. That's the objective of being self-directed.
Yes. And knowing how to make those decisions along the way is the reason why you got to really understand what your numbers are. You have to understand what your situation is, and so you can identify where your opportunities are, because that's the biggest point. So, you want to just jump in?
Sure, let's do it.
Okay. All right. Well, now I got to go find the thing. Do I think I'll leave you on there. Just you and the vibe board.
Okay.
All right. There you go. Oh, it didn't do a fun thing. I forgot to turn it back on. Yeah, dang it.
All right. So a consistent question that I receive is, "Hey, I am interested in velocity banking, but I just don't know how to get started." And again, as I mentioned, there's a lot of videos out there around. How do you get started? Like, what are those steps? Like, what do I do? And but before we even talk about how do we get started, it's what is velocity banking in general, even. Well, it kind of starts with obviously knowing your numbers. And every video that I've watched on where do I start, it is you first have to understand where the problem is. Do you know your numbers? And what does that even mean? Meaning, what are you spending monthly? What are you spending quarterly? What are you spending annually on debts and expenses? And what do those monthly payments look like? What does the balance do? When are the statement dates? When are the due dates? Because understanding the differences between the statement date and due date is important. Understanding the numbers around where money's going so you can identify what your cash flow is. The whole point of understanding your numbers is once you understand your numbers, you can identify where the cash flow is or where it isn't. And then usually it goes from do you know your numbers or understanding your numbers to then we have to identify a debt tool. meaning what is that vehicle you're going to use to be able to do velocity banking with. And there's many different options, right? And then the third step from there is once you know your numbers and you've identified your debt tool, you kind of have to build a plan. Like, where are you going? How are you going to get there? What are the steps that you're going to take to be able to achieve whatever the opportunity is you're trying to address? And then the last piece is you got to commit. You got to just jump in with both feet and understand that, hey, velocity banking is a strategy. If I don't apply this velocity banking on a consistent basis, I could get myself in trouble. Meaning, if I'm not paying attention to how bills are being paid, when they're being paid, what bills can or cannot be paid by the debt tool you're using, whether it's a credit card or a HELOC, making sure there's clarity around where money is going and what it's doing. If that clarity isn't there, you could really put yourself in an even worse situation.
Right.
And usually every video I've watched stops right there.
Yeah.
Know your numbers, identify your debt tool, build a plan to get there, and you got to commit. Usually stops right there. And I think I surprise some people when I meet with them because my approach is a little bit different. And as I mentioned, you got to know your numbers, right? Income, expenses, total debt, cash flow. I'll call it a pretty simple statement to make, but it can become quite complicated to kind of identify where everything is coming from, especially when I'm one of them. I know I have business expenses out there that I forgot about that have been just going on and just like those little small $2.50 or $100 a year type subscriptions. I am confident I have many of those. But the bottom line is you have to understand your numbers in order to effectively do velocity banking. And what we've decided to do today is kind of use a current client's example as to a call I gotten recently around, hey, can you help me eliminate $20,000 in credit card debt? And when I asked for the numbers, what I appreciated about this gentleman is he fully understood where his money was going. And in kind of identifying what his numbers were, if you notice that bottom number, that cash flow number is pretty significant. Brings home $5,000, and again, these are rounding, but brings home around $5,000 a month, has expenses of about $3,300. He's looking to address a specific bill. And this bill, this $20,000 in credit card debt, it's a $20,000 credit card, and it's maxed. It's like 19,486 or something like that, but it's roughly maxed out. But he's got 1,700 in cash flow, and in truth, to address that credit card debt, velocity banking isn't even a need; it's not required. But in using velocity banking to eliminate that $20,000 debt, again, just looking at the cash flow alone, it won't take him very long to address. So he came to me fully understanding what his numbers were. And as it relates to a debt tool, there weren't really many options to go after. He's currently renting, and he doesn't have a whole lot of credit card. That one credit card with that's maxed out is the only credit card he has. He could apply for a personal line of credit, but he has a different goal in mind. So he only has the one credit card. So his debt tool that we're going to use for this example is that credit card. And now I think I kind of caught him off guard because he was expecting me kind of to just jump in and kind of talk through how he could use his cash flow to eliminate his credit card debt quickly. And I kind of paused for a minute and I just asked a very simple question. But what's your goal? Because from my perspective, even though we talked through the steps of know your numbers, identify a debt tool, make a plan, and then commit to addressing, the debt in a consistent fashion, I always start with what's your goal? What's the point? Why are we even here? And from his perspective, his goal was to eliminate that credit card debt hard stop. But when you start to peel back the layers, you understand that actually it's not just to eliminate credit. Like, why are we eliminating the credit card debt? I understand that it's maxed out. I understand that it shouldn't be there. But what is the goal behind this initial or this surface goal? And as we started to peel the layers back, what I learned is the gentleman wants to buy a home. He's 35 years old, married. He's on a mission to be able to, within the next, I think, 3 years, to be able to buy a home. And what he's learned is this credit card that's maxed out at $20,000 is impacting his ability to be able to do so. So, what are the steps he can take to ultimately get to a point where he can buy this house? But you can peel that layer even further. Is it just about, because once you buy the home, once you've cleaned up your credit, you've qualified for this home, you've used velocity banking to be able to get yourself in position to buy the home, you've bought the home, you're in the home, awesome. But then what? Like, what's the goal behind that?
Right.
And he had some specific needs as it relates to this house. Hey, I want a 15-year mortgage. Why do you want a 15-year mortgage? So that I can pay this home off in 15 years. Well, why do you want to pay the home off in 15 years? Like, what are you looking to accomplish? And long story short, what we learned is his objective was really more around creating a legacy, building generational wealth, and putting himself in a position such that he can do what he wants when he wants. And based off his timeline, he was kind of compartmentalizing things, right? I need to address my credit, get rid of this credit card debt, buy this house. And then once I do all of these things, then I can start focusing on legacy and, generating wealth, if that makes
Well,
sense.
and there was another piece because they want to have a baby
Oh,
and they
no
want a
doubt.
home. They want a home to have that baby in. And so I came to advocate for a girl who was over there saying, "Can we please get a house? Can we please make this a goal because I know these are the steps and I want to do this in a responsible way." But I want a home to bring my baby home to. And so for them, this has now become urgent, right? So he's going, how what are the steps? How am I going to strategize to make this happen? And so not only does he have the pressures of he wants to, build the legacy, but he also wants to make good on this dream for her too, right? And for them. So
Absolutely.
there's a lot of emotional pressure there too.
And it was pretty interesting because that didn't come out until later, as far as the significance of really, it's really not about the home. It's about, hey, we need the space because we're wanting to start a family, and we really, want this snowball to start rolling down this mountain so that it can become a boulder, right? So
Right.
that didn't come out till later, but you're absolutely right. Again, but I go back to what's step one. Step
Yeah.
one is understanding, why are we doing this?
Right.
Like, what
Yeah.
is the real goal? It is not just debt elimination. It is
Right.
not just paying off a bill. Because think about it. Let's say you do velocity banking and you've paid off that credit card. Awesome. Awesome. If you really don't have any goal in mind, then that credit card is sitting there empty. You have cash flow sitting in your checking account. How did you get in this place to begin with? You probably got into this place to begin with because you had cash flow available to be able to use. So
Right.
unless you're doing this and putting yourself in a position such that you can use that cash flow to, I'll call it, accomplish another objective, you're kind of setting yourself up for maybe even what is it called, backsliding, making a mistake and ending up back in the same predicament that you were already in, right?
Well, yep. And I think the reason why it's important is because if you don't identify your goal moving forward, then the house and the baby just become the goal, right? That becomes the first milestone. And a lot of people get stuck there and they don't go thinking about or planning for, strategizing for that next milestone because even though there's a ton of handbooks on this, a lot of people don't have access to people that they can trust or where to get that information. It just feels like overwhelm, overload, and let me take it one day at a time. And one day you wake up, you said it earlier, one day
Yeah.
you
One,
wake
one
up,
day you wake up and you realize you're 50 years old and
right?
you're questioning, man, what mistakes did I make that now I'm here sitting at 50 and I have not accomplished the real goal? And the real goal was wealth and retire early or whatever those things were. But I've taken far too much time to get there. And now you look up and you realize time has passed you. And now you have to take some drastic actions to be able to achieve those goals.
Yep.
And again, from a velocity banking perspective, when people reach out, it's usually about a few basic things, right? It's about, I'll call it debt elimination. It's about buying some type of asset or thing or property, or even just simply buying a home, right? It's about credit repair, meaning I'm trying to get myself in a better position to be able to do other things. Meaning I'm trying to improve or increase or address my utilization, get that down so that my credit score can increase, so that I can do some other things. And then the obvious one is, hey, I just want to become debt free, right? I want to eliminate all of this debt so that I can become debt free.
Yep.
And usually the velocity banking process is pretty linear, right? It shouldn't be, but in essence, if I do velocity banking and if I'm, starting at a certain point and I continue that point and, follow all the steps again, I commit, I identify, I know my numbers, I identify a debt tool, I put a plan in place, and then I eventually get there. And in this gentleman's case, his goal is to, right, get a house, put himself in a position so that, hey, a home can be purchased and we can start building this family. Pretty linear process. But again, as we start peeling back layers, though, the truth is all of us, all of our goals really look more like this. It's really a bit more complicated. And that home or becoming debt free or whatever those actions are, that's really just a small step in this process of really getting to whatever the goal actually is. For some of us, it's wealth. And again, wealth is relative. For some of us, it's retiring early. It just really depends on what it is. But my point is, it is not as simple as, hey, once I put myself in a position to buy this house, I'm done. It's really understanding what your goals are and are you putting yourself in the right position to be able to achieve the main goal.
Yep.
So for this gentleman specifically, again, he had some basic wants. It was, hey, I need to pay off this credit card debt. I'm giving myself a 3-year window so that I can improve my credit. And again, if you look at his profile, looking at his numbers, I pulled it up earlier. Other than the $20,000 maxed out credit card, what else is there? Well, he does have a fair amount of student loans. And I personally believe it's the student loans that's having more of an impact on his credit. But addressing this credit card debt, again, because of his cash flow, is pretty simple. So pay off the credit card debt, improve his credit utilization, improve his DTI, improve his ability to be approved, buy a home. And again, he has a goal of paying that home off in 15 years. Again, when I ask why, and again, that's kind of I'll call it a silly question to ask, I know, because why else would anyone get a 15-year mortgage? It's so that they can pay their home off in 15 years. But again, go a little bit deeper than that and look at it from your own perspective. If you paid off your home right now, how do you benefit? Okay, the mortgage that you're paying right now, you're no longer paying. Okay, so your cash flow increases. Awesome. But how else are you benefiting from paying off your home? It's an asset that you're still living in, you're still paying bills from. How are you leveraging that asset to be able to put you in just a better position in general? Is it just the no longer paying the mortgage that you're satisfied with? For most of us, this is a 150, 200, 250, 300, $800,000 asset. Wouldn't there be an opportunity to leverage that asset a little bit better to put you in a better financial position? But anyway, buying a home and paying it off in 15 years was the goal. And then the last one being retire early. And as I mentioned, my objective is to kind of peel layers back. If you tell me you want to retire early, my first question to you is going to be, how? What vehicles do you have today? What vehicles are you contributing to today to be able to retire early? And for most of us, as it relates to the word retire, we have some basic vehicles. IRAs, 401ks, 403bs, TSPs, government 457 plans. With those traditional retirement planning vehicles, which one of them will allow you to retire early? How about none? And so if the goal is to retire early, my question is, what vehicles are you using to get you there? And if it's about a traditional retirement account, I'm sorry, but it doesn't exist. So I then bring that up to the top of the list. To me, if the number one goal is to retire early, it's how do you structure things so that you can start focusing on that? And again, this gentleman's 35 years of age. And so based off his goals, we built out a scenario.
Right. The way he thought it should go.
Exactly. And again, usually the conversations that I have are very, I'll call it straightforward and linear, meaning if I do these things, these are the results. And in his case, it was, hey, the first thing I want to do is use velocity banking to put myself in a much more credit worthy position. And as that cash flow increases, I want to also start to address these student loans. And I'm sure most people who have student loans are in a very similar position as he. And that is, as of right now, you're probably not paying on those student loans because you were waiting and hoping to see whether or not they would be, I almost said forbidden, but that's not the word,
Forgiven.
forgiven. I think most of us are putting ourselves in a position like, hey, waiting to see what's happened, but that ruling has now come down. So he hasn't been required to pay on them. And I honestly believe that's impacting his ability to be able to qualify for a home more than this $20,000 credit card. Yes, it's maxed out. Yes, its utilization is maxed. So getting this payment down makes sense. And so that's kind of the goal. And based off his income, as I mentioned, he's got about, what was it? About $1,700 in cash flow. Meaning using that cash flow and using that cash flow against that $20,000 debt, he can easily use velocity banking to get to a point where that credit card is, I'd say, within, let's call it 15% of the limit. And once you drop below 20%, there are some specific actions you should take. One of those actions is, hey, reach out to the credit card company and get that credit limit increased. Why? Just so that he has more room, so that he creates more distance and he doesn't hit his utilization as quickly. So in about, I'll call it 6 to 8 months, there's no reason why, using the cash flow that he has, is that this credit card isn't paid off. And the other step that we had taken is, okay, if you do that, then use the remainder of that time, because he has a 3-year window to be able to put himself in a position to be able to buy a home. So use the remaining, what is that, 24, 28 months or whatever that time frame is, to start to chunk away at his student loans. And in chunking away at his student loans, that allows him to be in a much better credit worthy position at that 3-year mark to be able to purchase this home. Now, simultaneously, again, when I asked what was your true goal, what was your main goal, what he shared with me was he is putting away $500 a month in a high yield savings account. Okay, and that high yield savings account, I think, is bringing him 3%. So that $500 a month for that first 3 years, inside of a high yield savings account, that $500 a month would equate to about $18K. So, and the reason I share this is that $18,000 is enough for that 3% down payment on that $300,000 home. $300,000 home, 3% down payment, $9,000. And so within that 3-year period, there is nothing preventing him from being, I'll call it, in position to be able to buy this house. But again, what happens after that? Well, the thought process was it would take him 15 years paying that house payment to get the house paid off. Okay, so in 15 years, once that home is paid off, then what? The thought process was, okay, at that 15-year mark, now it's time for me to focus on retirement. So let's look at some numbers, some age related numbers. He's starting this at 35. By age 38, he would be ready to buy this home. It's a 15-year mortgage, 38 and 15. He's 53 years old by the time he pays off this home. 53. He's starting his journey to creating generational wealth at 53. I'm not saying it's not possible. The dot I want to connect is that's pretty late. What are we doing between 35 and 38? What are we doing between 35 and 53? And yes, he is contributing to his company's 401k, but what he's looking for is a vehicle that can grow him, create generational wealth outside of his traditional retirement planning at his job. And okay, he's got this $500 a month going into this high yield savings account. Is that going to do it? And now, truth is, let's say at the end of the 15 years, he's got some money available to him. Here's what I know. I know doing that this $300 a month payment equates to about a $2,100 a month mortgage payment that he's paying on that $300,000 home. So at the end of the 15-year period, that 2108 a month is now gone away. It's okay. There's additional cash flow at age 53, and 2100 a month is a significant amount of cash flow at age 53 to be able to put away. In addition, he's paid off the home. So assuming he's going to leverage his home, there's a $300,000 lump sum. That's significant. That $500 a month that's going into that high yield savings account, again, it's high yield savings account, 3%. I think it's a 3% a month or whatever that rate is or how it's calculated. But using a compound interest account, we determine that's about $128,000. So that's significant. So $300,000 home that I can leverage, $128,000 inside of my high yield savings account, the $500 a month that I was contributing, plus the 2108 that I was contributing as well into my mortgage that I'm no longer paying. That's a significant amount of money at age 53. But what does that equate to?
Yeah, because it doesn't equate to retirement income at that point.
But let's be specific. It equates to $72,000 a year. And again, this is using a secure compound interest account.
Right, right, right.
It equates to $72,000 a year tax free. Again, using those large dollar amounts. And why is it only $72,000? It's because he said his goal was to retire early. I asked for a number. Said, I want to be able to retire when I'm eligible to be able to touch my company's 401k because I'll have both. So his goal was to retire at age 59 with a six-figure income. And just using his math, we step through how can you achieve a six-figure income using your current vehicles that you have available. And again, that is waiting till 53 before you start focusing on it, and using the equity, the mortgage, and the money that was sitting in that high yield savings account to all of a sudden jumpstart retirement. And it just simply using his process of doing things, we ended up with about $72,000 tax free. And I asked, is that sufficient? And he was not happy with that. Did you have a question?
Yeah, well, I just wanted to say that if you don't use a secure compound interest account in this equation, and he's just using the high yield savings account with
Right.
the house, and that's not enough. That's what I was saying. That unless you have like a super compounder added to the equation, then you don't end up with this, and you don't end up with this for life. This is why people are running out of retirement income, and they're not really educated on what this process is, because from their point of view to his point, he's putting in his company 401k. This is the whole reason why he's invested in that. This is the whole reason why he's taking these steps, is so that he'll be okay and everything will be taken care of. He's really thinking about it in, okay, from everything that I know, these are the steps. This is the way that you build wealth and that you have a secure financial future. But the reason why we pointed it out in this way, and this is just the point that I want to make, is that this is very linear. And this is if this, then that. That's what this is a statement. And
It's the compartmentalized thinking. I can't accomplish this goal until I can't accomplish the next goal until I've accomplished this goal.
You can't have your dessert until you've cleaned your plate, right?
Right.
And so therefore, and we all get that concept, right? That's very familiar to us. And we're just programmed to be like that. Okay,
Standard
if I,
conditioning.
if I do this, then I can focus on that. In addition, a lot of this stuff is overwhelming and it's a snooze fest to learn. So it's boring, it's overwhelming, it makes you feel anxious. And so if you can just grab onto one nugget, and just do that for a while, and you feel like, okay, now that I know that I've got this and I've achieved this goal, now I can move on and I have the time, the mental capacity to do something else. And so that's where I think this linear system has to be represented in this way, because we all approach it this way. Here's the point. When you go to watch some of these velocity banking videos and you're learning the process of velocity banking, coming up with your plan, everybody makes a plan like this. Everybody.
Pretty standard.
Yeah.
Pretty standard.
Everybody's plan looks like this. And this is part of the problem of realizing that you can't get the time back. So the cool thing is, we know how to supercharge this. That's the benefit. The cool thing is, we're looking way past that house, way past the debt, way past the next 10 years and what they look like. And that is not a goal at all. It is a part of the process, it is a step in the process. But by the time you get there, man, you're not going to have to go, okay, now that I got that, let me try to stomach the next part that's coming and hope that those same opportunities are there,
Right.
right?
Right. And
So I do want to ask if it's okay. Finish what you were going to say.
so I saw, I think Sylvia had a question.
Yeah,
Yep, I
that's what
can
I was going
address
to
it.
move to, if that's okay.
What is, because I can't read the question, but I can just see that she has one. What is the question?
Okay, let's see here. Sylvia says, and thanks for tuning in, Sylvia. How can someone do velocity banking with a variable income? Sometimes it's 2,000 a month, and sometimes 4,000 a month.
Yeah.
So
Um,
cute. Love this question.
yeah, and because I'm in a very similar boat, meaning because my income fluctuates, um, it's very difficult to nail down what that would look like. And for most of my entrepreneurs, they like to claim as little income as possible, so it's even worse. So this is a standard and a consistent question that I usually get as well. And what I usually say to that is, you have an average, meaning take a look at previous years, because I'm assuming your income was fluctuating in prior years as well. And you just do a simple average over the 12-month period. If your income over that 12 months is 100K, regardless of when that 100K came in, I would just kind of average that dollar amount and then use that as your approach to addressing whatever the opportunity would be from a velocity banking perspective. So I would say average your income and then divide that by 12, and that's the monthly amount that you would use.
And I think velocity banking is perfect. Putting yourself in the position to have leverage like this for somebody who does have fluctuating income, it means that you need leverage sometimes. And so, this, even though that's not exactly why it was designed, it is absolutely available to use in that way. So, for people who may have an opportunities flying at them all the time, and they need to get a hold of capital to invest in those opportunities, or they just don't have access to leverage in the form of credit, even, right? If you have a savings and that is only what you can go to if there are emergencies or otherwise, and those emergencies or those opportunities are more than what you've saved, and that savings isn't making you money. Again, velocity banking is not wealth creation tool, it is a debt reduction tool.
Right.
So that is why they both have to work together. Otherwise, again, you're not able to leverage that time to be able to build wealth. So for you, Sylvia, it would be even more important that you at least get some of these tools in place and understand how it works, because then when you do have a low month, if you do have needs beyond what your income is, then this is something that you can leverage. But it's not a suggestion of how to use velocity banking. It's just a perk for entrepreneurs who use this type of system.
Absolutely. Absolutely.
Okay, that's a great question. We got a few more, so let's
Yeah.
keep them rolling. Okay. Okay. What is the benefit? Antoine, thank you for joining. What is the benefit of using a HELOC or PLOC as our debt tool? I understand credit cards gives us points and rewards, but what is the incentive for using the mentioned tools?
Yep. So there's a standard question that most people who do velocity banking, or standard issue that most people who do velocity banking run into. And one of them is, I can't pay all of my bills from this credit card. So one of the issues with credit cards in general is you can get money into them with no problem, but not every bill can be addressed from it. Whereas a personal line of credit or a home equity line of credit, they're open ended, which means you can get money into them and you get money out of them. And those home equity lines of credit or personal lines of credit have a banking and routing number, which means you can pay any bill from those accounts with no issue. Every matter of fact, just using a just personal example, our home equity line of credit, we have a debit card tied to it. So I can literally use the equity in my home no different than a debit card for my checking. So one of the I call it the perks, or one of the positives around a HELOC or PLOC, is the fact that it's open ended. And then the other piece is how interest is accrued on lines of credit. Interest is accrued differently compared to a mortgage or compared to a credit card. Most lines of credit are daily, the interest accumulated daily, and it's simple, which means it doesn't accrue as fast. And so as you pay down the balance, it's a direct impact on the amount of interest that you pay the following month. Whereas in some cases, like a lot of loans, the interest rate is set and it doesn't change. The monthly payment doesn't change, and whether you put additional principal on the tool or not, it doesn't necessarily change the outcome of what you have to contribute on a monthly basis. So lines of credit are very significant, and you bring up this brings up a point for me that you didn't mention, but I want to share this as well.
Is it that what was in the comments?
Basically, lines of credit and how interest is accrued is very, very important. Using a line of credit to be able to pay down mortgage interest is powerful. I over these past few days, there were a lot of comments in the questions around. I'm sorry, a lot of comments in the in the in under the videos around using lines of credit and the interest rate. And because lines of credit interest rates are somewhat higher than mortgage interest rates, why would you use one versus the other? Meaning, just because a line of credit interest rate is higher than your mortgage interest rate, somehow the mortgage is cheaper. Somehow the amount that you're paying into your mortgage is more beneficial compared to the line of credit. And I say that to say not all credit, not how interest is accrued matters, and not all debt tools are the same.
Okay, that's not how they said it. If if anybody watching was in the comments on our last video, then they came for us. They came for Donnell, and they were trying. The math ain't mathin'. That's what they were in the comments saying. Why would somebody do this? And then they were going over to other videos saying, "Why this doesn't make sense? Why would somebody do this?" And I love the questions. One, because if it doesn't make sense and if we're missing something, right, we wouldn't want somebody feeling like they couldn't point that out to us.
Right.
We're human. But here's the part that was so important is that they were convinced. And I think
Conditioned.
this is the power of information and the power of perspective is that without it, you can believe things even if they're not true, right?
Right.
And,
And
and
be married to it. I
yeah,
mean, emotionally married to it.
but this is what the banks want you to do because this is how they benefit. So what he was saying is on a line of credit, if you're paying, let's say it's a 7% interest rate on a line of credit, right? On $20,000. Is that going to, and you're using that to chunk away and you're using that as leverage. And he's saying, why would you do that if you have a 3% or 5% interest rate on your mortgage? Because on the 30-year mortgage, a $300,000 house, you're paying somewhere around $700,000 for that house. And that doesn't even include PMI and
Yeah,
all
it's
the other little fees that you have that they get to add on top of that. And I think that's the math that we're just programmed to trust that math. And then we go, oh yeah, I bought my house for $300,000. Did you though? Did you? And if we can just do the math, we see that what the heck? Well, why do they even call it $300,000 then? They should call it you're buying in your house for 30 years. You're buying your house at $700,000, but they don't.
right.
That's the lie.
So what we committed to doing, and I shared this in the comments. I've kind of committed to, and I don't know if it will be Wednesday or the following Sunday, but what I want to do is break down the difference between amortized interest compared to simple interest compared to variable interest. And if you noticed anything else, if you haven't noticed anything else from our lives, I like to keep it simple.
He said student loans were
Yeah,
emoji.
yeah,
Yeah.
yeah. That sucks. The cool part about student loans, if there is a cool part, is most of the time the monthly payment is I'll call it not as impactful to like it would be a credit card.
Right, right.
But if you've got $200,000 in student loans, like that's an easy thing to say when you're not the one paying that $200,000 debt. So I
Yeah.
fully understand that.
And in the example that we're using today, he only has one credit card, so his trade lines are real limited too. So that's another thing.
Oh, absolutely. That is, I think that in all honesty is really what's impacting his ability to be approved. It is absolutely the lack of trade lines, the fact that his card is maxed out, and I do believe that his student loans are having a larger impact than maybe he may see. But regardless, because of his cash flow, he can make a significant dent in his student loans if he's structured correctly.
Yeah, and we're going to see that in just a minute. Two more comments. So we've got Creating Daily says, better call and get that PMI removed. He just got a $1,500 a year pay raise.
Yep.
And
Yep.
and all he did was restructure things differently. That's it, so that he now has the leverage. And I think that's what's crazy. We ended up buying down points on our first mortgage, right? The first
Mm-hmm.
arrangement that we had for our home. We bought down points. It was a couple $1,000s to buy down these points for a better interest rate, right? But the amount that it saved us or was would have saved us in the long run was insane. And if you just don't have access and or even know that these things are possible, then they get you. They get you.
You know what pisses me off about just the word PMI is if you don't call to have that PMI removed, it just stays there. Even though you've met whatever the obligation is, the bank doesn't care. They love the fact that they're receiving that extra $1,500. And unless you call and specifically take action to have it removed, it'll be there forever. Sad. It's absolutely
That
sad.
shouldn't be a thing. Right, guys? Put it. Do you agree with that? There should be a law about that. They should have to take it off. Okay, Tim. He is new to the channel, and this is his first live stream. Tim,
That's
did you
what's up.
see our intro? Was it lit? Because I'm pretty
We
proud of
played it
it.
twice for you if you didn't. So
A little bit twice. Okay, I would love to get your advice on getting out of debt. 150K student, credit cards, and using velocity banking and starting infinite banking strategies. Tim, you're in the right place.
yep.
Here's what we're going to do though, Tim. We're going to finish this example that we're giving today. And then I think I want to come back to this question when we're done because I think you might have some other questions or some of your questions might be answered by that. So
Yep. Let's
let's
do it.
let's see here. Okay, he's
Jump in.
got some more information for us, so that's good because we need some context and we need some details. All right, available credit, three separate PLOCs, 15 credit cards with about 100K of available credit. Psh,
Yeah, he's got debt tools. So
Tim's got a playground.
again,
Yeah,
as long as there's cash flow involved, I think the act of reducing or eliminating that debt, I think is pretty clean. But
yeah. Okay, last.
again, where did I start this? Even with those numbers, my first question is, why are we doing this? What's the
Right.
goal?
Yeah.
I
Right.
get it. And did I lose my sound?
Oh, you're back.
Am I still here? Okay.
Yeah.
I am not naive. I understand that eliminating debt is a goal. I fully respect and understand that. My point is, let's go deeper than that. Once that debt is eliminated, then what? Like what is the goal beyond that? It's the forest for the trees thought process, right?
Yeah.
What's behind, hey, once that is paid, what's your goal beyond that?
Yeah.
What does the
Let's go
next
deeper.
20, 25, 30 years look like? Because my question is, how are you going to get there?
Yeah.
And when are you going to start? And that's kind of what leads into our next the kind of the continuation of this example. But you want to address Antoine?
Yeah. Okay, hold on. I was trying to do something else.
Never knew a credit card. Oh, I see it. Never knew a credit card could be attached to a HELOC or PLOC.
Oh, dang it. Okay. Yes, thanks for answering my question. Much appreciated. Oh, and this is what I wanted to say to Antoine. We just did a live stream explaining this entire process step by step on how to set this up and where it's available, specifically how we use it. So that's obviously the best example that we could
The
share.
bank matters. The tool matters. Whether or not they can link, like there's all sorts of hoops you might have to jump through. But to answer the question of can you link a credit card to an account, you absolutely can. You absolutely can.
Can't you get a total refund on PMI?
And so that's where I'm outside of my scope. I would hope so.
Me
I honestly
too.
don't know. I honestly don't know.
Yeah.
But I would hope so because
But
if you followed this channel at all, you would know I am 100% against all mortgages. If any of you have a mortgage, my objective is to help you understand why the mortgage is actually probably the worst vehicle you have and the biggest vehicle that you have that's impacting your ability to actually generate wealth. But we'll get there. We'll get
okay, we're gonna move on, but I have this one last question. Prepper boss, because I like that question actually. Think about it. You better get your refund. Two, if they do give you a refund, are they going to give it to you with interest? Because you essentially gave them a free loan. because they
Damn right you
used your
did.
money. It didn't just sit in an account. They lent those dollars out multiple times in that amount. So you bet we're going to start a petition. Join our Facebook group. We're picketing in the Facebook group. Okay. All right, ready?
Yep.
Okay,
Jumping.
let's finish this example out. So we just went over scenario one, which was this viewer's steps, is essentially of how he was thinking that he would start velocity banking.
Yep.
So we just showed you that. Anybody who missed it can also scrub back and come back and join us live, or you can just watch the replay. And now we're going to go into the scenario that we created for him so that we could find him a way to get to six-figure income, tax-free income for life. And so, oh, we got another comment. Okay, we're gonna come back. We're gonna say this one because it's a good one,
You are
and we're gonna
hilarious.
get back into it, or we'll never get back. Right? All right, here we go. Hey, hey, it's back on.
The only thing preventing us from getting back into it is the producer, just so you know.
Okay.
So just to recap where we've been and what we've done. Again, his goal was very specific. Hey, I want to be able to get into this home, and then once I pay off this home, I'll focus on retiring early. And again, just putting dollars and cents to those specific actions equates to about $72,000 tax free for life. And I will show at the end how I came up with this number, because this is not a number that I just made up. It's a number that if these actions are taken, these steps are taken, and he takes these actions, this is the income that he would be looking at being able to have on top of his traditional retirement account.
Right.
But again, in peeling back a few layers, there were other questions that were asked around, but what is the true goal? Again, if we're talking about buying a home and paying that home off, that's only part of the process. Once that home is paid off, what is the true goal? And he was very, very adamant about generational wealth. He wants to be able to put his family in a position such that for the next 500 years, they're taken care of. And so my question was, okay, you're here. What are you doing right now at this point to be able to get here? Like, what steps are you taking? And if you go back to the numbers on the previous slide, if you're 53 by the time you pay this home off and you're trying to retire by 59, that's a pretty long distance to go to be able to create generational wealth. And so again, it started with just some very simple questions. What's the goal and why is that the goal? And here's what we learned as we kind of peeled these layers back.
Yeah.
Yes, the goal is to buy a home, but why a 15-year compared to a 30-year? Because I want to pay the home off faster. Okay, if you pay the home off faster, what does that accomplish? Well, in the midst of kind of peeling these layers back and identifying, yep, they want to build a family, want to have a family, and they want to make sure the place is large enough for that family. What I learned out of that was their goal. This gentleman's married to a young lady from South Africa. Their goal is to eventually even move out of the country. So what that means is the retirement goal is to not even be in the States. So if the retirement goal is to not even be in the States, then whether you pay the home off in 15 years or 30, how does that impact or change or shift or help your ability to generate that wealth, especially by age 59?
Will
And
they be
so,
done with it?
right, right. And so we just had a lot of conversation around the home in general. And so the first few steps were the same though, right? It
Right.
was, hey, use velocity banking to eliminate debt. And when we use that velocity banking to eliminate debt and pay on your student loans, your credit improves. And now once your credit improves and you have a down payment, you're able to go buy that home. But I started with an action to help him get to his original goal. And that action was, you've got cash flow. His cash flow is right around $1,700 per month. So what if you take $500 a month and put that into a secure compound interest account?
Yeah.
What if you simply use, because again, the cash
Up
flow is
front.
there. He's got $1,700 a month available to him. What if you just simply take that $500 a month, take $500 a month out of that cash flow and start a secure compound interest account? Meaning you're starting a vehicle You're putting your money in a machine that can actually help you get to retiring early. Because as I mentioned earlier, name one other vehicle, especially as it relates to traditional retirement, that can help you get to early retirement. And most people say real estate. So unless you're buying properties, flipping those properties, or buying holes to sit on those properties to generate income over time, what other vehicles are there that's going to help you retire early? And again, he's a biochemist actually. And as a
Cool.
biochemist, he doesn't have a whole lot of time on his hands. So real estate isn't an option. This has to be passive.
I was just gonna say, you gotta be into it. It's not just go do this. You gotta really be into it.
Right. So the first thing we did was we identified that, oh, okay, so what are those vehicles? What is a vehicle he could start right now to be able to produce, to at least start down the path of creating generational wealth? So it started with putting $500 a month away in a Skia, and then using velocity banking to eliminate debt and address his student loans. What that ultimately did was it kind of started him down a different path than what he was expecting. And then the down payment for the purchase of a home is still coming out of a similar place. Meaning, for his example, on the 15-year mortgage, the down payment was coming out of his high yield savings account.
Right.
Well, if he's putting $500 a month away into a secure compound interest account, that is a savings account.
Right.
But
That
here's the
grows
difference.
faster.
But here's the difference. The high yield savings account, I think the number was around 18 grand. Over that 3-year period, would have accumulated around 18 grand, $500 a month, around 18 grand inside of his high yield savings account. The down payment for a $300,000 home, 3% times 300,000, $9,000. So the down payment is a $9,000 payment, or a $9,000 amount to be able to put a down payment on that $300,000 home.
Yeah.
Okay. When you take 9,000 out of the 1,800 of the high yield savings account, what's left? Okay, there's $9,000 left, meaning you eliminated 50% of your high yield savings account. Well, as it relates to a secure compound interest account, if you needed $9,000 at year 3, you would be able to leverage that $9,000 from yourself, which means you're not depleting that 18,000.
Right.
The life insurance company is writing you a check for 9,000. There is an interest rate tied to it, but it's a simple interest, 4% interest rate that you choose whether or not you want to pay it or not. But the bottom line is, that $9,000 check is now being used to go purchase this home, but your 18,000 is untouched, which means
It's
that
still
money is
growing.
still working for you.
That's
That
right.
machine is still building over time with that $18,000. So at a minimum, he didn't hurt him, because again, goal is to retire early. MPI is a vehicle that he's going to use, or secure compound interest account is a vehicle he's going to use to get him to retire early. And even leveraging the 9,000 that he needed for this home, he's not hurting himself.
And he's wanting uninterrupted growth, uninterrupted progress is what he was seeking essentially in all of his terms that he listed in his goals. I just have this question. Does
Yeah.
anybody know what this looks like? This game board? Because I intentionally used it, but I just want to know if it's just making sense to me or if everyone else is like, oh, I that looks familiar to me. So I want to know that. There's like a 7-second delay, so I wouldn't see if anybody is responding until then. But the concept is the same. So I just wanted to make sure that it was like a familiar thing and that this was tracking. So throwing that out there. Okay.
Absolutely. And so, in addition, though, I mentioned this home. So if the objective is not to be in the home forever, then why spend so much money up front? Because if you remember, the 15-year mortgage was around $2,108 a month.
Yeah.
Well, a 30-year mortgage, $300,000. Okay, I think it was something like $300,000 for a 15-year mortgage. It was 3.25%. And then a $300,000 for a 30-year mortgage was 4%. So obviously a high, or do I have that backwards? Anyway, regardless, the monthly payment on the 30-year mortgage was about $1,400. So $1,400 compared to $2,100, there's a difference there. And so if the first 3 years was filled with $500 a month going into a secure compound interest account, and then buying this this 30-year mortgage compared to this 15-year mortgage, there's $676 there that's available to also start compounding inside of a secure compound interest vehicle. He's actually 3 years ahead of where he would have just started using the 15-year mortgage. And again, if the goal is not to pay the home off, the goal is not to be in the home forever. Now he's be in a position to be able to set himself up to be able to use that home even further.
Well,
And go ahead.
but only because here's and no, creating daily. It's not the game of sorry. Sorry,
It
that's
does
not
look
it.
well. It's the piece though. The game piece you used is a
Yeah,
sorry game piece. So
you're,
I'm with him on that.
that's fair. That's fair. It's a shoots and ladders game, and there's a reason why. Because what he's explaining is that because you started the secure compound interest account. I don't know if you guys can see that little VIP pass I added there. It means that now you have the VIP pass because you've prepared yourself. So, Tim, this is where this would probably perk your ears up with all the leverage that you have. What I see is that you've been collecting leverage. And so this is where that would apply to you. By having the secure compound interest account, you're putting yourself in a position like having a VIP pass that you get to now take these shortcuts, right? You get to now take a different path, and you get to now the hacks and life hacks or financial hacks or whatever those are, you get to take shortcuts that other people just simply cannot because they don't have leverage and they cannot take advantage of the opportunity. So that's why.
And now, also looking at ages. So again, starting the same process at age 35, and then buying this home at age 38. Now, from age 38 to age 59, his objective is to retire early. And notice, I have retire early, not the end game. The retire
Right.
early is just another step in this process.
Because what he didn't say, the unspoken end game was legacy, was generational wealth. He just didn't
Yeah, it
list
absolutely
it.
came out. It
Yeah.
was about generational wealth, and generational wealth just means, hey, I want to be able to leave a legacy. And so, because retiring early was not the end game, I wanted to make sure there was a process that we identified to help get him to that end game of generational wealth. And so, in creating the 30-year mortgage and the savings on that 30-year mortgage compared to the 15-year, again, there was additional money that was available to then put into a secure compound interest account. What it does is it helps this process move by faster. And there's an item that we didn't even discuss. I laid it out there on paper form, but we didn't specifically walk through it. And that was, what if you converted that 30-year mortgage to a first position HELOC to be able to leverage even faster? But even taking that out, from age, what is that, age 38 till 59, just paying the normal mortgage will allow him to be able to get to a point.
No, that's the with the $1 million baby. You took the $1 million baby shoot.
No, the $1 million baby is an option, is an
Yeah.
additional option. But
Yeah, I
even
know.
without that, pulling that lever of the $1 million baby, which we'll talk about, even without that option, his ability to be able to get to 109,000 in tax-free income is still the same because it's just math. It
Yeah.
is based off this $500 a month that he was contributing, plus the $676 a month that which is the difference between a 30-year and a 15-year mortgage, and plus that secure compound interest account, the amount that he had accumulated in the first 3 years. The first 3 years was right around 18. I think it was like 18,360. And so, in the process of putting these dollar amounts inside of a secure compound interest account, is what got him to that 109,000 of tax-free income for the rest of his life. But again, along this way, there are other levers that can be pulled. One was the home, converting the 30-year mortgage into a first position HELOC. How do you leverage that? The other is, yes, as you have kids, as you make more money, as you grow in the company that you work for, you're also earning more income, which means your cash flow should change. Your cash flow should improve. This is assuming no change in cash flow. But let's say his cash flow does change, his cash flow does improve. There's an opportunity to introduce a secure compound interest account for your kid.
Well, you could leverage your current policy to do that too.
There's all sorts of opportunities here.
You could leverage the HELOC to do that too.
Again, they don't call it infinite for nothing. There's
Right.
all sorts of opportunities here, and I
But
think the key here, the piece that I just want to make sure sticks is this: how do we come up with a concept like this? How do we come up with a process like this if we don't fully identify the goals?
right.
And my point is, when you're doing velocity banking, it's not just about that debt that you're wanting to eliminate. It starts with first, what is the true goal? What is the object? Once this debt is eliminated, then what? Once that mortgage is paid off, then what? And is there something you can institute starting now to put yourself in a position to be able to achieve the actual goal? Because here's my point. Because he started this secure compound interest account at age 35, because he started here putting away $500 a month, this $500 a month has been compounding for 3 years before we even added this dollar amount. And when we added this dollar amount, I'm sorry, this $500 a month had been compounding for 3 years. And then when you add this dollar amount on top, it just compounds even more, which puts you in a position to be able to achieve that 109,000 tax-free for life.
For
And
life.
for life. And a lot of words, but let me show you how.
Okay.
If you don't mind, slide over to the calculator and let me show you mathematically how we came up with this 109,000.
That was so smooth. Slide over to the calculator. Let's go. There we are.
All right. So hold on, let me clear some of this out. I was playing with it earlier. So again, kind of just setting the stage for that. So again, he started his secure compound interest account when he was 35, but I'm going to start at age 38. So he's been doing this for 3 years, age 38. And we're going to compound this thing till his desired retirement age of 59. So that's his early retirement age. There's a lump sum going in here. He had this secure compound interest account for 3 years. During that 3 year period, there was an amount accumulated. So I'm going to use that as the amount of lump sum that we're putting in here. If you remember, it was 18,360. And his monthly contribution was a combined dollar amount. It was the dollar amount from those first 3 months, the $500 a month from the first 3 months. And then now that he's gotten this 30-year mortgage compared to a 15-year mortgage, his monthly payment reduced, and the difference between what he was willing to pay and what he's currently paying is all I'm using. I'm not coming up with a new additional dollar amount that's separate from his cash flow. He was already prepared to pay $2,108 a month because he wanted a 15-year mortgage. All I'm doing is saying, if you take a 30-year mortgage instead of a 15-year, that difference in payment, difference between 2,108 and 1432, that difference is 676. So $500 a month plus 676 equates to 1176. So if he was just simply putting away from age 38 to 59, that 18,360 lump sum plus 1176 a month, it equates to $109 tax-free for life. But let's break this down a little bit. This $109 is that annual income. And that's starting at age 38. He would have accumulated cash value of almost $1 million, $958,000. And his ultimate goal was legacy. Well, this vehicle builds legacy as well. And what I mean by that is, if something were to happen to him, he's purchasing a life insurance policy for about $700,000. But as this compound, as it grows, the death benefit, which is two numbers, the death benefit, if something were to happen to him later in life, is the life insurance plus all of the cash value that wasn't used, which equates to a total of $2.9 million. Show me the high yield savings account that can produce a legacy of $2.9 million. It just doesn't exist. And so in simply starting earlier and being diligent about or committed as to what the goal actually is, put him in a position to be able to achieve this 109,000 tax-free for life. And again, it's all starting at age 38 till age 59, that one-time lump sum of 18,360 and 1176 a month in contributions, and he's there.
Yeah,
And
and there's just
notice, I don't have him making more money.
right.
I don't have him converting his 30-year mortgage into a HELOC.
That's right.
And I do not even have him doing policies on his children, which you're absolutely correct. Because of this projected cash value here, he can use a portion of this dollar amount to open up policies on his kids. He doesn't even have to come out of pocket to do that.
That's right.
So there's just so many layers here that aren't discussed. And I go back to the original question around what are the goals. If your goal is to retire early, what other vehicle do you know will allow you to be able to touch your money at age 59 without being penalized?
That's right. That's right. I love it. Great job. I think that these steps are going to change the game. They don't align with other people's steps out there. So there's that. We also
Well,
noticed,
just to restate that, when if you were to put in the search bar of YouTube right now, where do I start?
but
How do
don't
I
do
get
that.
started?
Stay here.
Of course.
Okay.
But how do I get started? What you're going to see is know your numbers, right? Identify a debt tool, personal line of credit, credit card, whatever it is.
Make a plan.
Make a plan,
How do
meaning
you
where
make
are
the
you going? Where
plan?
are you headed? Where are you
Yeah.
headed? And then you have to be committed. From my perspective, I think it looks a little bit differently. And I think it's really more focused on what is your goal. And we've got I think a summary slide
Oh,
also
yeah.
that kind of talks through it, but
You want to go to that?
that's
Yeah.
fine.
Okay.
So this summary slide, I think it highlights what those steps are, but I think order matters because the way this reads, know your goal, know your numbers, identify a debt tool, make a plan, pay yourself first. From my perspective, the first step one is knowing where you're headed. So what is the goal? What's the point? But the second step is to pay yourself first. And I don't care what your goal is. If your goal is to eliminate debt, if your goal is to buy a home, if your goal is generational wealth, if your goal is retire early, how do you get there if you don't put yourself first? And paying yourself first means exactly that. Before you pay a bill, before you pay your mortgage, before you pay Netflix, pay yourself first. Put your money in a position such that it's working for you. So know your goal, pay yourself first. And then if we're talking velocity banking, you have to know your numbers. You have to understand what's going in and what's coming out. And then identify a debt tool. What tool are you going to use to be able to address this debt by using velocity banking? What tool are you going to use to be able to do so? And you have to commit. You have to make a plan. You have to sit down and kind of map out how you're going to achieve these things. And I think in doing so, you can achieve your goal in velocity banking. I'll say fairly successfully, but it starts first with understanding where you're going.
We had one more slide. Did we skip it?
I don't know.
It's above that. Yeah.
Yeah, this is just a recap of kind of the two scenarios. Meaning, he came to me focused on one thing, and it was I want to be able to put myself in a position to be able to buy this house. And so, using velocity banking to pay off a credit card, fairly self-explanatory. And again, because his cash flow is around $1,700 a month, it's a no-brainer. And again, whether you use velocity banking or not, paying off that credit card is an easy process to do because he's got the cash flow to be able to do it. Improve his credit score. There are some actions that have to be taken there. If you don't use velocity banking, it is going to be difficult to improve your credit score quickly. But using velocity banking allows him to pay that balance off faster. And again, if you follow my thought process on this, once you get it below 20%, you reach out to that credit card company, have your credit limit increase, not to use it, but to put yourself, and again, in a much better credit utilization position, a much better credit utilization position. And so, in doing so, and again, also using that cash flow to address his student loans puts him in a much credit worthy position to be able to qualify for paying or buying a home. His goal was to pay it off. as far as I'm concerned, I don't know why people want to pay their home off if they're not going to leverage it. If you're going to sell it, I get it, pay it off. But if you're paying off your home strictly for the elimination of the mortgage payment, I think there's other ways to go about it. There's other actions you can take that can actually put you in an even better position to be able to achieve your true goals. And then obviously the student loans. I don't have in this scenario, I don't have him paying off student loans at all. I think using velocity banking to aggressively address getting the balance down low enough to where it's not impacting your credit makes sense. But using an excessive amount of cash flow to pay the student loans off, I don't see the value there,
Right.
especially if the goal is retire early. If the goal is not retire early, then absolutely. If the goal is to pay off student loans so that they're zero, then yes, absolutely pay them off. But if the goal is to, again, if the goal is to achieve early retirement, if the goal is to put yourself in a position where you can now fire your job, you have to start as quickly as possible. You have to start as early as possible to do so. And sometime paying off debt to start that transition to generating enough income to be able to retire early, that hurts you because it forces you to lose compound cycles, meaning the amount of time it takes your money to double. You're losing compound cycles as you're waiting to pay off debt versus paying yourself first, putting your money in a position to where it's working for you. And that includes your home. And then the
That's right.
last piece is the retirement income, the difference in retirement income. And that math, again, I can show that math as well as to how we accumulated the 72,000. I showed you the 109. I can absolutely walk through the math of the 72,000 as well because it is an absolute real number. But the point I want to make there is waiting till 53 impacts your ability to be able to truly retire. If he would have started that 10 years earlier, 5 years earlier, he would have been in a much more positive cash flow position.
I like that one too. Okay, so how do you get started? Well, we made a tool for you. Now we get to finally show it. So we've had about, I don't know, 20 people now grab this. We had made a post about it. We started that Facebook group because people were in the comments like, yes, I'm in. Let's do a Facebook group. So we started one. So you can go to selfdirected.info/live right here. That's where you get it. And about halfway down, you'll see the calculator. Click on the button, tell us where to send it, and then we'll give you all of our free tools, which includes 2 free books, a comprehensive video series on a secure compound interest account, how it works, why it works, and it answers a ton of questions in there for you. What else do we have in there? Oh, case studies. We have tons of case studies. And then, of course, you get Donnell's digits. So now you can text him anytime with any questions, which many of you have, and we welcome that. So anytime you have a question, whether you're in with the calculator, if you are uh, reading the books, watching the videos, it doesn't matter. If you have questions, text them to us in real time so that you can get that answer. And the Facebook group, honestly, guys, is a place to meet other people who are on the same journey as you. That's pretty valuable because a lot of us, we're the pioneers, right? Out here breaking cycles. And our mantra is if you didn't come from wealth, from if you did not come from a wealthy family, make sure a wealthy family comes from you.
That's
This is
right.
how we're going to do it.
That's right. That's right. Sounds like there's some questions.
Yep, we have some questions. So I just want to make sure that we showed um, this tool and made sure everyone knew how to get access to it. Okay, let me turn the stinger off here so we don't keep going cycling through that. Okay, here we go. Okay, we got Tim. I was going to call on him. Tim, are you still with us? Because I wanted to hear. Did you hear my comment? So I'm glad that you commented to let me know. That was very helpful to hear that suggestion about ways to access our credit as leverage to reach our goals much faster. And that's the whole point. That was the whole point of using that game because when you get that VIP pass and you have leverage, it is like instead of taking the stairs, you get to slide, right? It is just like that. So thanks for tuning in, and I'm glad we're grateful to have you on board. Hey Celeste, thanks for tuning in. We've seen her before, familiar face. She's like fam now, huh? Paying myself first, got away with that because of my debt.
And I think that's a lot of us. Because it sounds strange when I say pay yourself first before you pay Netflix, right?
Yeah.
It's easy to, matter of fact, it's easy to say. It's a challenge to do. And again, I fully respect and understand that. The key is this: where you put your money matters.
Yeah.
The key is when you're paying yourself first, just putting it in your savings account isn't enough. It's where are you putting your money so that your money is making its own money. Because what happens when this momentum starts to build inside of your, let's call it a secure compound interest account, as
Right.
that momentum starts to build and you run into a situation where debt has taken a turn, inflation has grown, so now I need to address my credit card debt faster. Because your money's been making its own money, you now have extra income that you can leverage to be able to address that debt as well. So rather than going out and getting a personal line of credit or having to go out and get a home equity line of credit, you might even be able to leverage yourself, leverage your own bank on yourself
Yes.
using your secure compound interest account to be able to address those same debts. That is why paying yourself first is so important as well.
Man, and becoming your own bank, just the fact that this is possible, right? Like, how many people until recent years even understood that the concept was real, that you could literally become your own bank? So, well, that's another part. We're done with the gatekeeping. So, we're here to share all the secrets and they're not being kept behind a paywall. Hello, guide. This is the comment that I saved. You're doing a tremendous service to many people. I've been following your classes. This is my first live. Welcome, Willie. And I need your help getting out of my debt. We are here to help, and we just showed you how. So if you go there, you can also book a call with Donnell. Right there, selfdirected.info. Matter of fact, I could put that.
And let's also talk about that call a little bit. Because again, I'm different. My objective, well, let me just step back, I guess, and talk about credentials. Like, who am I? I'm a retirement planner. I'm focused on producing income, and it's not just retirement income. It's about income. When you're ready, the goal is to be able to help you hit your goals when you're ready to hit them. And so, as a retirement planner, I have no problem assisting, helping, talking through velocity banking and how I can help you hit your goal. But I am not a velocity banking coach. I am here to focus on income. And so my questions are really more purposeful, meaning it's less about have you identified that debt tool? It's really more about why are we even doing velocity banking? What is the ultimate goal? Why are we here? What is the purpose? What is the point? Because once you address that debt, then what? And are you putting yourself in a position to be able to hit those major goals? So again, I have no issue meeting. I have no issue talking through velocity banking and how you can get out of debt faster and what tools are available. And there's been several clients that what I do is I'll come up with what I would do over the first 3 or 4 or 5 months, and then I give that back to you. I'm not suggesting that you do it. I'm just sharing with you, this is what I would do. This is the approach that I would take. And sometimes it's outside the box, meaning sometimes I will take a measure that maybe you didn't think about, mainly because you gave me a goal. I'm going to try to hit that goal. So I will provide my suggestion, and it kind of lays out what those first few months look like. And if you continue those months, you'll be able to hit your goal with no problem. But again, this is not I'm not providing financial advice. This is just simply my opinion as to how I would approach the same problem.
Yeah. And the Facebook group is a great place too, because you're meeting other people on the same journey. This is a great place to collaborate. And that way, if somebody has like Tim, all these questions would be so great in the Facebook group because then everybody learns together. And on top of that, the next question that I'm going to pop up could be something where other people go, hey, wait a second, I had that issue, or I'm steps ahead of that problem, right? So this is how I solved it, and there we kind of follow the each one teach one, because again, the objective is not for us to be some experts and then everyone's dependent on we're the only ones who can do this. Everybody can do this. We believe in every single one of you. Everybody can do this, and everybody can learn this. So welcome aboard, all of you who are watching today and all of that watch the replays too. We are so grateful for the response that we've gotten, and we've not been on here for very long, but tell your friends, bring them back. All right, is there a way to get access to borrowed funds from an MPI before 3 years, or do most plans require 3 years of payments beforehand?
Great question. MPI is somewhat unique, meaning here's what we ask as we're creating secure compound interest account, like a premium finance strategy in the form of MPI. What we ask is you allow your account 3 years to compound, meaning that's the ask. But there's no contract that you've signed that says you can't access your cash value. Your cash value is your cash value, and it can be leveraged at any point when you're ready. But there's something special that happens inside of this specific product at year three. High level example. You're putting in $500 a month, $6,000 a year into a secure compound interest account. $6,000 in year one. Can you leverage a portion of that $6,000 in year one to go do velocity banking, do whatever you want? 100%. No one's stopping you. The ask is you allow that year to the first 3 years to compound. So you put in 6,000 in year one, you put in 6,000 in year two. That's 12 grand. At year three, when you put in that third 6,000, so you've put in 18 grand. The life insurance company comes along and says, hey, because you have met your obligation of funding your policy for the first 2 years, here's an additional $6,000 that you're able to leverage to grow your account faster. Meaning, at year three, you're not just making money off the 3 years of $6,000 you've contributed. The life insurance company has now added an additional six, so that's $24,000 working for you. So if you want to leverage that money at year three, you have even more available to you because you have allowed your account to compound over that 3 year period. But things happen. Let's say at year two, you leverage $5,000 to go address, you needed to get something fixed in one of your rental properties or something like that. Okay, not a problem. All that means is the impact on that leverage of $5,000 looks like this. It may cause your ability to be able to add that additional leverage at year three, however months it would take to compensate for that $5,000 that was used. That's all that changes. It impacts the time, but the growth is still happening, and your ability to leverage the amount coming from the life insurance company is still available to you as well. So it's an ask that you allow 3 years, but there's nothing contractual that says you cannot use your cash value when you want to. You absolutely can.
Business development, thank you for joining our live stream. How do I find you on Facebook group? Do we have the link? The link is, if you go to selfdirected.info/live. And if you go to that page that I just showed, then there's a link there with the Facebook icon. Or if you opt in for the Velocity Banking worksheet for us to send it to you, we also send you that link. So it's nice and convenient. You get all of our free resources all packaged up into one place. So that makes it nice and easy. Thank you for asking that question. Okay, we got Willie G. He has now he has a question. He had a comment. Now he had a question. Can velocity banking work for me being 65? Great question.
Velocity banking is a strategy that allows you to eliminate debt. So absolutely, it can work at any age. The key to velocity banking, again, is the goal. And then also it's those basic steps of understanding your numbers and identifying a tool that you can use to do the velocity banking, building a plan around executing it, and then just committing to getting it done. So absolutely doesn't matter the age. It's really just about reducing debt so that you can increase your cash flow to hopefully put you in a better position from a cash flow perspective. So absolutely.
Nick. He says, what if we don't have Facebook? I know there's a lot of people
Then
who
hang
don't
out on
have.
YouTube.
Yeah, that is what we're here twice a week.
Nick, jump in the comments. Let's talk.
Yeah.
And
You gotta get over here.
Me personally, if you wanted some time with me, just get on my calendar. It's not hard.
Yeah. All right. Oh,
Fake.
man. I gotta throw this out here. Been watching
I love
Fantastic.
I've
Yeah.
just so we're clear, I do velocity banking. And I didn't jump into velocity banking because I'm some guru on YouTube teaching people how to do velocity banking. It is a strategy that we use. I have some fans that I watch on a regular basis. Denzel Rodriguez is my guy. He doesn't know me from the man in the moon, but as far as how he articulates velocity banking, it resonates with me. Fantastic. I love her as well because it's simple. Another thing you'll notice as it relates to me compared to other people who do velocity banking, they are very specific about the dollar amounts they use. They do math down to the penny. Why? Because they want to make sure you don't, if you have a challenge as to what it is they're putting on their whiteboard, they want to make sure that when you do it yourself, you come up with that exact same number. I am very different. I am focused on strategy and I am focused on structure. Becoming self directed is about structure. And if you're structured properly and you understand the strategy in detail, it doesn't matter the number. It doesn't matter whether it was $354 or $300 or $354.32. If you understand the strategy, this works. And so I focus on high level. How do you get the strategy across? And these other Fantastics, what are some of the others? Denzel, these other, I'll call it social media influencers that are very, very strong in this process. I love them to death. But that is not what I do. I am not a velocity banking guru. I'm a retirement guy. I'm an income guy.
Yeah.
I want to show you how to make income.
Yeah, and I personally, I think there is one difference here. I check out when I'm watching those videos. You in the beginning when you were like we're going to do this velocity banking thing, watch me go, and I was like I will cheer you on, but if we got to sit here and do all this freaking math, I am not with it. Like I'm not with it. Get somebody else to do it. I'm sorry, I can't. I just literally was checking out. It was too much, boring. I couldn't even sit through a whole video. It was painful. I would rather do anything else, literally anything else, but I knew I had to learn if this was going to be part of our wealth, our strategy for building the legacy that we wanted to make sure that we passed on, right? Like if we really wanted to achieve our goal, then I had to learn this stuff. I know that there are other people that feel like me. I know there are other people who are staring at those whiteboards and they're just like, my God, could you pound it in? If I've watched 100, could I at least get some of it to stick? And it's really difficult to go and watch those that style sometimes. It feels like class. And I'm going to tell you right now, I did not do well in that environment in school. So therefore, it's not going to be happening. It doesn't matter how old I am. My brain is just like, no, 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 don't do it.
I think you bring up a really, really powerful point because you're absolutely right. The visuals that you create kind of bring this home and it allows to kind of wrap, even though you bring up visuals and I gloss over some of the details of those visuals because I'm focused on math. I'm a
I
math
know,
guy.
right?
Whereas you are focused on, hey, do the visuals connect to what the math is doing? And I think that's why this process works because if it was up to me, it absolutely would be all numbers and it would be a fire hose of information and a whole lot of people would be checking out. So I get it. I totally get it.
Yeah, I feel like if it's a story, if you can tell it in a story, it is much easier to consume. You know, we watch a movie, and if there was a movie about math and it was tied to some narrative that we were all like just locked in on, we would all walk home knowing the math. So if there was a velocity banking action film, like could you imagine? But there's not. So we have the shoots and ladders for now. We have all of the other stories. Emma, who do we have out there? We got videos that tell these case stories. We've got one for Emma, Mike,
There's a lot.
Jason, Alex.
There's a lot.
We've told lots of different
We got
stories.
Dorothy.
Oh, we even did a Wizard of Oz series. So don't miss
We've got
that.
Mortal Kombat.
We got Mortal Kombat. I did well, it was a Street Fighter. I turned you into a Street Fighter character.
Like Mortal
The
Kombat.
point is, yeah, the point is that I get really bored and before we were live streaming, I had to edit this stuff. And as an editor, I was just like, kill me now. I don't want to do it. No. I can't. Please. Can we find a way to make this more entertaining? If not just for me, so I could edit and get through it, for everyone else who wants to watch it. So
Nick, I believe you are not alone. I think a lot of people have focused on velocity banking because there was a time when inflation was better and the economy was in a different position, that there was a lot of, I'll call it PLOCs, HELOCs available to us, and a lot of us became over leveraged. So there's a lot of us in a negative cash flow position. And so you are absolutely right. It is next to impossible to do velocity banking without positive cash flow because what happens is Robbing Peter to pay Paul only lasts for so long because the debt tool that you're using, the balance ends up increasing and you're not decreasing it, and you end up putting yourself in a worse position. So you're absolutely correct. So I think you are speaking to the masses, because I think there's a lot of us in this position who are currently over leveraged, which is also why I take some pretty drastic approach to putting yourself in a more positive cash flow position. Meaning,
Right.
if you are contributing to, let's just making up a story, if you're contributing to your company's 401k, whatever that dollar amount is, but you are drowning in debt, maybe you should pause your company's 401k, take that monthly amount that was going to your company's 401k and use that as cash flow to help get you into a more positive fashion. That does not feel good, and I understand how it sounds coming out of my mouth because it's very easy to say. But so I get that it's a challenge, but it is absolutely an action that I would take. Why? I have to take a drastic measure to get in a much more positive cash flow position. Why? Once I'm in that positive cash flow position, I can you do velocity banking, pay down debt at a much faster pace, put myself in a much higher cash flow position, which means now I can go focus on my retirement and dump even more in faster. I can get there faster because then I'm in a much more positive cash flow position. But until I have positive cash flow, it is very difficult to take action. So, you know, second position HELOCs, those are an option. Personal lines of credit, those business lines of credit are an option. There's many different options out there. And so I agree with you. Doing what's necessary to get into a positive cash flow position, it matters, it's important, and it's virtually impossible to do velocity banking without doing so. So I'm right there with you, man.
Yeah, and Nick, we also did a video on that. So I don't know what his name was. I don't remember what the character's name is, but we told a story. We did a case study telling the story of a person who did have it was negative cash flow to begin with, and they ended up crushing $51,000 in debt. So the thumbnail on that video is 51,000 negative dollars in debt, and then it shows like the debt going down and then the cash flow line going up. So that's the thumbnail that you'll want to look at. And that's here already, ready for you, packaged up. Okay, next one. Jason Garcia. I'm having trouble on part 2 of velocity banking. My bank doesn't allow the option to link my HELOC to my checking account for overdraft protection.
Got it.
Yeah, Jason, I don't know if you saw it was our last stream, right?
I think so.
Like one
There's a
in the
lot.
last week or so. Yeah, we just covered this particular thing and that this can happen sometimes.
Yep. So there may be situations where you need to leave a certain dollar amount in your checking account to address those bills that cannot be addressed using your debt tool. Like sometimes you just can't get around it. But the cool part about a HELOC is it does allow you to chunk. So you would have your normal payment coming out of your checking, but you would use your HELOC to chunk at the debt, which still will allow you to address that debt, just as fast, even if all of your income isn't going into the HELOC. But that is so I do respect that is a challenge. And I think in the comments there was a lot of people challenging the fact that I say I'm doing this, I showed that I was doing it, and still being told that it can't be done. You absolutely can connect, depending on who you bank with, depending on what their rules and rules of your strategy would be. But the bottom line is you can link your checking account or link a debt tool to a checking account as overdraft protection to be able to pay all bills from that debt tool, which could be as easily a credit card or a HELOC. You can do it, but I do respect and understand that there are some companies out there that make this very, very difficult for you. And I think along those lines, it's then you keep the dollar amount you need in your checking and you use the debt tool for what you can.
Yeah, well, and I'm going to say this, Jason. He's so nice in how he says things. I'm going to say this is why it's really important with who you bank with. So even when you're going into your velocity banking journey, maybe in the middle of your velocity banking journeys, when you found these hiccups, who you bank with matters. And developing a relationship with your banker, this is also why this matters, because just because a bank offers something, like I was mentioning in that video, our last stream, Donnell has been on the phone with countless bankers, countless lenders, explaining to them how their products work, and they learn something in They have to go talk to somebody, and then that person calls Donnell and they go, we didn't even know that it could do that. We didn't know that we offered that. We didn't know how it worked. And he's explaining to them how it works. And then he gets a call from some higher up, and they're going like, hey, thanks for training our team. But the truth is, they did offer it. It's just so uncommonly it's just not common for people to use it. So most of their people are never even trained on it. And in addition, why would they train them on it? Because most of these products that you can leverage for velocity banking, when you start to use the bank like the bank's using you, they're not pushing these products because they're not as profitable. So you may have to do some homework and you may have to educate yourself on what those products are, but you can absolutely walk in if it's your bank and they offer something. Sometimes they'll say no, we don't, no, sorry, we don't do that. And you could just turn around and say, do you? Do you though, Janice? Do you? Do you? Do you not, or do you? Because we need the fine print. We need to look and see what's available. Or it could be possible that they just simply don't, because these products aren't this type of leverage for you is not as profitable for them, so they may not offer it at all. Know who you bank with and
But
what you're.
you said it, but I gotta peel it back a little bit further, and that is who benefits,
Yeah,
right? When
yeah,
if you were to walk into Bank of America right now and say, I'm looking to buy a home and I want to buy that home with a first position home equity line of credit, there will be a line. So every banker you run into is going to do his best to put you in a mortgage. He's going to explain to you all of the woes and scary nightmare stories about having a HELOC and why you don't want one. He's going to try to explain to you that his 5.5% interest rate on this mortgage is far better than this 11% HELOC interest rate. And the math doesn't say that. But the person selling you the product is going to say that all day long. Why? What do they benefit by doing so? When we
right,
converted our mortgage to a first position HELOC, the closing costs associated with that was zero. It cost us $150 to change our mortgage to a first position home equity line of credit. How much money did the bank make on that transaction? Not a whole lot. Versus had I been refining into a mortgage, we're talking closing costs, we're talking all of these other pieces that the bank gets paid off of. So what is the incentive to advertise a first position HELOC on the front page of Bank of America? There is no incentive. In addition, who actually understands how these products work? When you're talking with someone who all they do is mortgages, they have a list of products that they are trying to sell you. Nowhere in that list of product is a HELOC because they don't make any money off of it, so they have no idea that it even exists. So you will have to educate banks at times to be able to help them understand what is available.
they're like, it's dead to us now. If it doesn't show up on my paycheck, I'm not selling it to you. It's
Hey,
dead to me. So don't ask me about it. But if you really kind of want to dig further into that, you could watch the Wells Fargo documentary. I'm always sharing a scandal up here, but it's because some of the whistleblowers, man, they are powerful, and they have pulled back the curtain and exposed the wizards. That's what we're doing too. So if you're into that kind of thing, the retirement gamble, I probably say this every single live stream. The retirement gamble, watch it. And if you have, let other people know right here in the comments how valuable that documentary is. Wells Fargo documentary, also a lot of tea spilled in there that you probably want to see. Okay, let's see. Oh, these people are just talking back and forth. Okay, we won't share the business. Okay, here we go. After I do my payments, I will deposit the remaining back into the HELOC. Oh,
so if you're using your HELOC as a debt tool, then all of your income should be going on to that debt tool, and you should be paying bills from that if you're doing velocity banking using a HELOC. But again, if there's some bills that can't be paid from that HELOC, then that dollar amount would stay on the checking account. Again, this is where you do have to dig into the details of who it is you bank with. You're absolutely right, sweetheart. Who you bank with matters because you want to understand, can I keep my checking account at a low dollar amount? They may have a minimum balance requirement, so you're not charged any additional fees. So you want to
right.
make sure you maintain whatever that dollar amount would be. Our specific situation is I can absolutely keep my account zero and not be impacted. but you do want to understand, and just so we're clear, how do you understand what your bank will or will not allow you to do? Call and ask. I'm not saying you pull out your statement and you dig into the fine details. No, have a conversation with a live person over the phone and walk through what it is you're trying to do, because it's their job to educate you on whether or not this is even possible or you're capable of doing it. So please, I am not saying go get your statement and figure this out on your own. Leverage the people who should know, but be prepared. You might have to educate them on some things that they don't even know is even possible. So,
Yeah. How do you get a HELOC?
so it depends. And I've been just haphazardly using the word HELOC. I am actually meaning something specific.
Yeah.
Home equity line of credit, there are many types. There's a first position home equity line of credit. There's a second position home equity line of credit. All of them can be used as a debt tool. But when you hear me reference a home equity line of credit, I am only talking about a first position home equity line of credit. Meaning, if you have a mortgage on your home, I am talking about replacing that mortgage on your home. Again, using this example of a $300,000 home. Let's say you got a $300,000 mortgage and the home is worth $400,000. I am saying going to the bank, refinancing that mortgage from that $300,000 mortgage to a $300,000 home equity line of credit. What happens when you do that? The bank's going to take that $300,000 home equity line of credit, pay the mortgage off. Well, what's the difference in a mortgage payment versus a home equity line of credit payment? A mortgage payment is traditionally a principal and interest payment, and it's an amortized debt, meaning you're paying majority of the interest up front for the first 15 years or so, and then you start eating up the principal, which means over that 30-year period, you're going to pay double for that home.
Yeah.
Versus
Look at your schedule. Blow your
a
mind.
first position home equity line of credit. How does that kind of how does interest grow inside of a first position home equity line of credit? In most cases, it's an interest only payment. Well, clearly, if you only pay the interest on a $300,000 first position home equity line of credit, you will not pay that product off. So that is not the point. So you definitely don't want to pay interest only. But because you're only required to pay interest, that allows you to be able to take all of your income and dump it onto this vehicle. If you took all of your income and dumped it onto a mortgage, can you access any of the money you just put on? No, which means mortgages are closed in products. HELOCs, first position HELOCs, are open ended, meaning I put all of my income into the HELOC. I can immediately take out every dollar I just put in that HELOC the next day, if not the next hour, meaning it's an open ended product, which means I can get money into it and out of it. So how does that help you? Well, as you pay down a HELOC, because it's a simple interest product, not an amortized, because it's a simple interest product, the minute you put a dollar on that HELOC, it changes the amount due, meaning it changes the interest due because the balance immediately changes. Whereas an amortized loan, even though you put more money onto your mortgage payment didn't change unless you call and have it changed. But the amount that you're paying every month doesn't change. Whereas with the HELOC, as you put money on that HELOC, that interest that you owe changes. It gets smaller and it's immediate.
Yeah.
And so if you're dumping all of your income onto this home equity line of credit, you're putting yourself in a position where you're creating this difference between what was originally owed on the HELOC and the equity, the value that you're able to access. And that equity is available to you at any time. You have now become a bank, because now you can take that equity, that arbitrage, that difference between the balance that you originally had, 300,000. Let's say you've paid off 50,000 of it, so you only owe 250. That 50,000 is available. What could you do with an extra $50,000?
At any time.
And now you take that $50,000 and put it into a secure compound interest account that's working for you. Okay, cool. But what just happened inside the HELOC? If I took 50,000 out and put it somewhere else, the balance just went back up to 300. So it's almost like I'm starting all over again. So what? Because when I put all of my income back onto this debt tool, just like Velocity Banking, what happens to the balance? It goes back down.
Right.
Then I take some equity and throw it onto a wealth building tool. Then what happens? The balance goes back up.
Yeah.
But so what? Because I'm going to continue doing Velocity Banking. And again, all of the strategies we talk through talk. The reason we talk velocity banking is so that you can take this concept and actually put it in a position so that it can work for you, so that it can build wealth for you, so that you can attach it to a wealth creating tool so that you're generating income for the rest of your life.
Yep.
Man, that was long winded. Sorry.
Man. Okay, and real quick, just before we get on to any more comments, because the majority of the rest of the comments were asking this question. How do we get started? How do I use Velocity Banking if I have multiple credit cards? How do I get started? That was the whole topic of this particular live stream. And this is how you can do it. You can join. We've seen a lot of different tools out there. Uh, I like to make mine look pretty. So that's what I did for you. And what you'll do is you'll download it here, selfdirected.info/live. I'm just being honest.
You're saying facts, and I'm giggling because I have not heard one lie.
Yeah,
She likes
let
to
me
make them pretty.
I
She
like to
does.
make it look good. And so
That's why
I
I'm with
think
her.
the experience is part of the journey, right? I think it's important to me. What's important to me. So I made that for you guys. Anywho, there's a 5 pages in as a part of this workbook, and you'll go here to not here. This is to join the group. But if you go here, you can join the group and grab that worksheet all in the same place. And I think by next week we'll be able to take callers live too. We might be able to do it on Wednesday if my kids give me my dongle back. That's really what this is coming down to is I keep asking who took it, and
Amazon has dongles.
but sometimes they don't work. You guys know the stress of this. Okay, so I need to get my dongle back. It's the principle of the matter, or we'll order one. Point is, go
Best
here,
Buy
join the
has
group.
dongles.
Go join the group, grab the worksheet, then you fill that out, and then if you want to do a consultation with Donnell, at minimum you'll have all of your numbers together. There's some cool stuff in there. I'm not even like an Excel expert, and I was able to put this together. There are areas you just start with filling in the sheets, and then I will come in the group and we're going to work on how to do this whole thing out. So maybe Wednesday I'll do a full walkthrough of how to use this particular workbook, but it's really not hard. You just put, right now there's figures in there so that you can see how it works, but then you just go put your numbers in there, okay? I'm going
In
to stop talking
addition,
about it.
we also want feedback as to how it is or is not working, meaning we're looking
Right.
for bugs. So please go grab the workbook so that you can also assist us in any adjustments that may need to be made to make it more user friendly as well.
Yeah, absolutely. This is a community effort. And that's where, other than Nick, sorry, guy, he's not on Facebook. So, Nick and any of his non Facebook
Fake book.
friends who are watching right now, I'm sorry, you guys, but that's the place that we got to put it at. Where else are we going to go? Can't have a group on Instagram, can't have a group on Twitter. I don't know where else to go. So, if you guys have a better place, let's do
You can go
that.
to
But,
Trump's site.
well, I don't have an account there. So, there's that. We're moving on from that conversation. This is where you can get it, guys. And we're really excited. And like you said, we're looking forward to your feedback. So that's really, really important to us. Okay. So on that note,
Willie G. I
Willie,
love the name, by the way.
where can you send your numbers? That's where selfdirected.info or selfdirected.info/live. You will find a plethora of fun tools to use and dive into to really help educate yourself, because our mission is to help you get self-directed. This isn't about us being experts. This is about, we're part of your community. So get in here. Get in here when we're live, wherever we are on social media. But if you sign the form, tell us where to send that information, then you'll have access to Donnell's number, and you can contact him there all day long. Please do it
But let's also be a
all
bit more
day.
specific around send you my numbers. If we're talking velocity banking, absolutely. We just walk
You,
through greatly how to get the workbook and be able to put your
yeah.
numbers in, all that kind of
Got to
stuff.
have
That's
the
awesome.
workbook though. Don't
But in
just come with your
addition,
numbers.
right? But in addition, though, what about, hey, I'm 45 years old, I make X amount of dollars a month, and I'm looking at a secure compound interest account, and I want to be able to I want to know what it would look like if I was to start a secure compound interest account today. You also have the ability to anonymously share those numbers as well if you didn't want to share them in the comments, for me to be able to pull up the calculator and show what it would look like for you as well. So you have that ability too.
Yeah, and there it is right there. So you could screenshot it if you want, or scrub back and replay it. That is for you. Okay. Tim's coming for us, and I feel like this is like an okay boomer comment. So I don't know, Tim. I don't know where you're going with this, but I do hear you on the Discord. I know you know what Discord is, right?
I know some kids play video games using Discord. I mean, no, I take that back. So I do meet with a lot of people all over the country, and I have actually used Discord several times to be able to do presentations for real estate groups. So there are a lot of people using Discord out there, and I'm not opposed to that either. So I'm kind of joking, but do I have a Discord account? Absolutely not. So
But we love that you offered that to us, Tim. Thank you so much, because you are right. There's tons of people using Discord, and I'm in a few Discords. I'm still trying to understand it because there's not a lot of pictures, and I like to look at things. So it's a little bit how to organize all those conversations. It becomes not a vibe for me. I'm just going to be honest. Facebook is where it's going to be for right now. But if somebody else wants to start one on Discord, we'll jump over there and chime in. We can definitely do
okay,
that. And
no
I can
problem.
we can show Donnell how to use it, and maybe we can just clip this part out that we signed our kids up to kind of help you out. We'll do a tutorial over dinner. Maybe that's how we do it. Okay, so we've covered the worksheet. We wanted to do that. How you get started on in velocity banking, how we do it, which is completely different. So anybody who's just tuning in, you might want to catch the replay so you can see that we're a little different. We approach things a little bit different. Our whole goal in approaching velocity banking is part of a 5-part strategy, like he said, that all feed into each other. They
They
all
all talk.
connect,
They all talk.
and it's all a part to help you become self-directed. So, on that note, do you have any
I don't.
last words?
I don't. I'm good.
That sounds so horrible to say at the end. Any last words? Like I'm gonna.
I'm good.
Okay. I think there's like a 7-second delay, so I want to make sure the comments do come in if there are any last one.
I will say this: we haven't acknowledged Ken. I just want to make sure.
Yeah, Ken, and he said he never had PMI on his mortgage, so I love his comments. Savor the flavor. So thank you so much for tuning in, Benita, over here on LinkedIn. She says she's finally catching it live.
Nice.
Yeah, I love that for you, Benita. She's always commenting on the replay, and then of course we're not there in real time to respond to her. And Anthony. So Jamal, we've got Annie, Ken, Robert, Dan Roth. Yeah, we had quite a few people tune in and still watching over on LinkedIn. So we appreciate all of you here across Facebook, YouTube, LinkedIn for tuning in, for helping us build a community. We believe that we grow faster and farther when we grow together. And on that note, I'm Angelique Stidham.
And I'm Donnell.
Oh, here we go. Well, one
Get
last comment.
self-directed.
You both are amazing, and I'm very glad to be here. I also really like your goal to equip us with financial strategies to reach our goals and have cash flow for life. Thank you. Keep up the good work.
I
Thank you
honestly
so much,
believe it's
Tim.
purposeful. I'm again. This is us sitting on a fence with our hand out, just trying to pull people up. That's all. That's all. It is not. It's not hard. It is just simply math.
And I think that that's what a lot of people are out here doing. I think everybody's in it for a different reason, or maybe at a different part of their journey, has a different approach. We just do what we do, so we don't really worry about what other people are doing. And we love to hear your comments, your feedback, all of that in the chat, so that we can learn how we can serve you better. So, okay, hold on a second. Let me get back in where I was going. I was gonna play the next one. Where did it go? Oh, here we go. Okay, we're gonna start over our ending. We're trying to work on our ending. It needs to be cool, and we just haven't figured it out yet. Okay, I'm Angelique.
And I'm Donnell.
Okay, Thanks for tuning in. Okay, we're going to ask ChatGPT and do some outros next time. Hold on. We want to show you guys how to get all of the free resources. So that's what's coming up next.
Till next time.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you
Get self-directed. Hey, before you go,